So let's just walk through your two phases, and you see two distinct phases, and investors basically should focus on specific asset classes as those phases evolve from the first to the second. And the first is pre-pivot, and the second is real rates. So talk us through the first and the second phase, and ultimately when you think our audience will have to negotiate that transition.
Yes, that's a key part, Jeff. The idea is not to pivot too much into an asset allocation that is consistent with falling interest rates, right? As I've said, there is one stage before that, which is high and stable interest rates. And the asset allocation you want to have in that context is different than in an environment where interest rates are actually falling. They won't fall before a while. So high and stable level of interest rate probably means that you want to favor assets like corporate credit, particularly high quality corporate credit in dollars. You can move down a little bit the credit rating up to perhaps triple Bs. But the idea is that the asset class of choice in an environment where you continue to have pressure on the system, you continue to have high levels of interest rate, is very certainly corporate credit. Then at some point, if inflation really comes down to more comfortable levels, the Fed might guide for lower interest rate down the road, but that might be in the final quarter of next year, maybe more a 2024 story. And it's only in the context of falling interest rates that you want to add equity risk, tech risk, but probably in a second step.
Yeah, and gold you also see as being important in that mix.
Well, gold does well when the dollar weakens and when interest rates fall. So indeed, it's a little bit too soon, perhaps. I think we would prefer carry strategies where you get income rather than rushing into gold right now. We get into gold when interest rates will fall further, and with it, the dollar. So it's a little bit too soon in our view.